All right, then the headline inflation rate for June 2025 moderated to 22.22%. That's in the month of June. The inflation rate that's relative to what we had in May 2025. That was higher. That's 22.97% in the month of May. So there was a difference of 0.76% looking at what happened between the months of May and June. Now, this was disclosed not by me, but by the National Bureau of Statistics. That was on Wednesday. According to the latest Consumer Price Index report released by the Bureau, the year-on-year inflation figure represents a 0.75 percentage point decline from what we used to have, and a significant 11.97% drop when compared to June 2024. On a month-on-month, we have this 1.353% in May, and that's a bit up of 1.67% from the figures we have in the month of. That's the Consumer Price Index for that month-on-month rate that we have. Now, the decline in annual inflation is being recorded against the backdrop of a rebased index with 2024 as a new base year. Now, on a month-on-month basis, like I said, inflation rose slightly to 1.68%. That's blind to looking at this, and compared to 1.53% in the month of May. There was also a difference. That suggests that while the pace of price increases is slowing on an annual basis, prices are still rising faster from one month to the next. That's what this figure is telling us. Let's look at some of the figures for the year-on-year figures. Transport, 2.37%. Restaurant and accommodation services, 2.87% increase. Food and non-alcoholic beverages, 8.89%. The NBS report reads that the Consumer Price Index rose to 123.4. That's in June 2025, reflecting a 2.0 point increase from the preceding month. That's 121.4. In June 2025, the headline inflation rate is to 22.22% relative to the May 2025 headline inflation rate of 22.97%. Let's see food June CPI, 40.87%. That was in 2024, and it's now down to 21.97%. Don't forget, it's a rebased CPI that we have here. That's why we have this bit of drop that we've seen here. Month-on-month core inflation rate for June CPI, 2.46%. That's for 2024, and that's 1.10% for May. That's 2025. Well, that's a breakdown of some of the figures, but I have with me in the studio the head of research at Ankoria Assets Management, Mr. Olua Odetunde. She's already looking at me here and ready to break this down for me. I've been waiting to have you in to do that. Thank you so much, Olua. It's good to see you today.
Good afternoon. Thank you for having me.
Yeah, thanks so much. Let me say first how you will react to these figures. Many will say, well, it was expected. We've seen that decline for 3 consecutive months now. Yes. So what were you expecting at Ankoria? Let me take it from
Yes,
there.
we did expect a decline in inflation. And I mean, when you look at analyst forecast, I think the expectation was that inflation should land between 22% to around 22.5%. So I think every other person has actually forecasted a decline in inflation. But I mean, when we did see, the numbers, 22.2%, I mean, it was positive. It was a welcome development. But I think overall, it was a mixed bag kind of data. I mean, on the nominal side, inflation is coming lower from 24% in January 2025 to 22% now, so that's positive. But when we started to look at, the food index and the core index, we started to see that, price pressures are still quite persistent on both legs. So by and large, I would say that overall we had, nominal figures appear, quite positive, but we noticed that the major driver of the, that downward trend in inflation is majorly driven by mathematical computation, which is, that very high base effect that we had in 2024. Like you had earlier mentioned, we had inflation as high as 34% in June 2024, but, now, and when you're also looking at those CPI numbers, I mean, we're having lower CPI numbers, despite the fact that inflation has somewhat, stabilized, so to say. But the fact that we had a high base for last year, it appears that inflation is coming down. So it's more of a mathematical computation, not necessarily that we do have some level of deceleration deceleration happening in terms of inflation.
What are the key drivers for you? What do you make of the key drivers for inflation at this time?
Okay, so I mean, like we did say, that decline was majorly driven by the high base effect, but we did see some pressure on the food basket as well as the core basket. On the food side as well, we saw that for the month of June there was some insecurity and as well as some violence in the middle belt. The major food producing states of the Nigerian economy. So that definitely started to affect food inflation. Also, we saw some pressure on the transportation index. So when we saw the transportation index actually recorded a negative growth of around 0.3% in May, but what we saw in June was that transportation index actually increased to around 2.04%. So we saw a lot more pressure on the transportation side of things, even when we didn't necessarily see an increase in farm produce index. We actually saw that the farm produce index actually moderated. We recorded a negative growth around 13%. Compare that to where we were in May 2025. Farm produce index accelerated by over 22% on a month-on-month basis, but we did see, a negative growth recorded in June 2025. So I think by and large, we saw that, pressures came from the food side, pressures came from the core basket side, but, that figure continues to show us that, the nominal figures continue to show us that inflation is, decelerating, but we don't necessarily think so yet.
It's worrisome because I'm looking at the year. You talked about the devastating effect. Many farmlands and businesses are forced to close. Agricultural producers, feeling this bite very seriously. But let's stay with food. Is there any quick wins for government? Because I think it's really worrisome and scary at this time. What can be done? Do you think anything can be done to help address this and have a bit of stability? Because Nigerians really want the price of food to come down one way or the other.
So I'll say that, in terms of food prices, we did see the data was more or less mixed. So in some major food produce such things like rice, pepper, we saw increments in all of those, but there were some indexes that showed us that there was some form of decline. So I think when you put all of those things together, that was what led to that inflation looking like that figure. But when to address your question, so to say, I think it just goes back to the fact that we still need to see a lot more investment in the agricultural sector, and you would see that what is being practiced in the agricultural sector is majorly subsistence type of farming. I think if we go the mechanized way, it will, this insecurity that we are currently seeing that's been distorting, farmlands and all of those activities, I think it will start to reduce. If we are seeing more investment in mechanized farming, you'd see that we'll need less, farmers on ground, so to say. We'll have more tractors, we'll have more machineries and all of those things. So, who would the headers be? Who would the others be attacking so to say? Exactly. So, in terms of also, cultivation and harvesting as well, if they're able to do a lot more mechanized farming, you'd see that, all of those things will be faster. All of these seasonal factors that we're already pricing into inflation, we're expecting now that inflation should, there should be further pressure on the food index. We're expecting that, in June and September, we tend to see that the rainy season tends to peak between June and September. So that will definitely affect farming activities. But, if we do go the mechanized farming way, you see that some of those effects will be curtailed, so to say.
Let's look at the central bank's angle of this now, because I am looking forward to the next MPC meeting. We're always waiting for that meeting to know how it's going to shape the direction of the economy moving forward. Are you thinking that, the Cardoso-led CBN has focused on, that stance of, very, very tight monetary policy, I would say, but you won't blame them because of what they made on ground and all of that. Do you think that we are getting to that point where there might be a shift? That's one. Then also this inflation curve. Do you think that we are now at that point where it starts to really, really come down, that we start to feel that impact?
So I'll answer your second question first. I think that we'll continue to see inflation decelerating till the end of the year. I think where we might see inflation accelerate will be in December. But that's due to, when we saw that rebasing happen, we saw that the December figures were actually tweaked. using the new reference year. So I think we saw inflation come down significantly in December. So I think by the time we are seeing these inflation figures for December 2025, we might start to see inflation bordering around 34%. So we like I said, we actually do see inflation coming down to below 20% for most part of the year, but December there should be a spike. So going back to your question on what is the central bank governor likely to do, we think it will most likely adopt a hold stance at this meeting.
I think so too. I must say, I think so too.
I mean, and I think it's important to look at the setup to the MPC meeting. One will be that we do expect, inflation to still continue to face some pressures, and I mean, when they look deeper into the numbers, they would still see on a year-on-year basis, on a month-on-month basis, both food and core indexes are showing signs of pressure points. Apart from that, we also saw the Purchasing Managers Index for the month of June 2025, which is a leading economic indicator. And I mean, we did see that input prices are accelerating much more faster than output prices. So it means that currently producers are the one absorbing the higher production cost, and along the line they will start to pass on that higher cost of production to consumers in terms of higher goods and services. So we do expect pressure points from that end as well. Another thing we want to look at is the fact that IMF has been advocating that Nigeria keeps a tight monetary policy stance in 2025. We know that majorly inflation in Nigeria is really driven by supply side factors, and monetary policy can majorly cure the demand side factors. But in order to signal to the market, in order to signal to investors that it wants to stabilize prices, it still needs to keep interest rates high. And we know that the Federal Reserve hasn't yet cut any rates yet. We've seen other central banks move in a different direction, but we know that the main central bank hasn't yet delivered any rate cuts, and is due to factors like the tariff uncertainty. And another thing you'd also want to consider is all the oil production figures. We know that the budget, 60% of our budget is dependent on the oil performance in 2025. So I mean, we have a projection of around $75 per barrel, 2 million barrels per.
We're here to hit that.
Yeah, we're here to hit that. The last
but I think production is improving.
Target. Yeah, I think what we saw for June 2025 was that production did increase to around 1.5 million barrels per day. If we include condensates, that was what increased to about 1.7. But I mean, we are in line with target, but we are not in line with targets of the federal government. And I mean, I think according to analysts, the expectation is that oil prices are expected to still continue to make their way down. Yes, we are seeing some short-term volatility in terms of the geopolitical tensions. I think recently we heard that Iraq was attacked. Some of its oil fields were attacked. But that OPEC has mentioned that it intends to increase its oil production target. It has said it wanted to roll back some more cuts. You know that in 2023, 2024 time, it cut back about 2 million barrels per day from the crude oil market. But now it is releasing. It's going to start releasing about 1.9 million barrels per day production volumes to the market. So I mean, I think analysts like even Goldman Sachs, they forecasted that oil prices should be as low as $56 per barrel. So how does that affect Nigeria? It affects us in the sense that our revenue generation will start to be impacted. And if revenue generation is impacted, that means they would have to borrow more. The federal government will have to borrow more, and that will put more upward pressure on inflation, so to say. So I mean, if you look at all of these factors, yes, we are seeing signs of stabilization in terms of the energy index, in terms of the FX cycle as well. But in terms of all these other pressure points, I think they still remain quite prevalent. So we do expect that we would see a hold cut at the next meeting.
There's a bit of fear from that angle, I must say. Beautiful analysis. I must give it to you. The use of trade policy tools to also address cost of import inputs into the economy is something that some analysts have recommended. You've touched on the tariff issues and all of that. Exchange rates, use import duties for trade related. What do you make of trade policies at the moment and how it affects import and exports?
Regarding our trade policy, I mean, we have seen that since in the last year, we've been recording a trade surplus. So that has been very positive. It had a positive effect on the exchange rate as well. But I think recently we started to see some level of softness in that trade balance, so to say. So I think our trade policy at this point still remains quite positive, but when you look at it on a grand style, I think what a lot of countries are currently considering is how much trade surplus do they have with the US. We know that the US, the largest economy, is looking to deliver significant tariff increases to a lot of countries. So what is currently our trade surplus to the US, I don't think is much. And if you look at the quality of what we also export to the US as well, it's mostly commodities. There are no high valued products, so to say. So if when Trump is targeting a lot of its other trading partners, he looks at the guys that have high valued products that they are bringing into the US, so to say. But Nigeria, we don't necessarily have that. So in some way, we are insulated from that, those global economy effects, so to say. And that's why we've seen, foreign investors are starting to make their way back into our capital markets.
I also see in my research that the CFA franc compared to the Naira is quite stronger. And some say that is encouraging large-scale export of Nigerian agricultural products. What do you make of our currency, at the moment? I always like to ask this question, and I'm going to ask you today. Is it appropriately priced?
I think at this level, we can say that,
fairly, right?
it's fairly priced at this level. And when you also look at the assumption of the federal government, where they expect inflation to be this year, they do expect it to be around this 1,500 levels. And we think that they will still maintain, that inflation, that exchange rate at that particular level. So I think definitely, should we want to see more downward pressure in terms of, exchange rates, I think we need to see more in terms of the high valued kind of export products that we're giving out to other countries. So we just need to see that there's more value, the kind of products that we're giving. But currently, we still see that a lot of the our export products are majorly commodities, which has not been very supportive of our Naira. So we just need to see more. And then in terms of encouraging foreign portfolio investors to come in as well, I think we also need to see more in terms of stabilizing the FX environment. And like we said, foreign portfolio investors, is still a lot hot money. We still need to see more long-term investments, like foreign direct investments, come into the economy. Those ones will stay longer, and that would, be able to help, the federal government, achieve some level of stability in the exchange rate environment.
When we say that exchange rate, that is, like you said, fairly priced. But do you also see that we're still having that continuous handshake between both parties? I'm talking about the fiscal and the monetary side. Of course, you would complementing each other at this time.
And I think, in some way, we're starting to see some level of fiscal consolidation happen from the fiscal side of things. So I would just like to take, let's take a cue from, fixed income activities recently. So you'd see that we saw the third quarter issuance calendar, for bonds as well as for treasury bills. It showed that, the central bank as well as the DMO, they are reducing their debt issuances into the market. So they are not overflowing the market. They are telling us that, in terms of borrowings, they want to take less, from the market. So I think that has already started to signal, to investors that they are, they're trying to maintain this current pace of borrowing. They don't want to overshoot, such that it doesn't affect inflation, it doesn't affect borrowing costs so much. So I think they are doing so much more, on the fixed income leg, trying to control their borrowing costs, trying to do a lot in terms of, trying to refocus more or less their attention towards, bringing in foreign portfolio investors into the market. So I think we should still continue to see this trend going forward. But I think what appears, a bit unlikely is the fact that we might continue to see, slower debt issuances. We think that going forward, that those debt issuances might most likely increase, just going back to the fact that the oil sector might most likely underperform in 2025.
Interesting. So in 1 minute, can you say what your outlook is looking like? What are your projections?
So definitely we do expect inflation will continue to make its way down in 2025. But I think, like I said, at the end of December 2025, we expect to see some upshoot of inflation. But on an average basis, we do expect that inflation will border around 24 to 25%. Compare that to where annual average inflation was at 34%, 35% in 2024. So I do expect that the inflation outlook still appears quite positive for the economy at this point in time.
Orolu, I hope to see you before that inflation figure comes out. Maybe we'll have another discussion then and project ahead of that again. Orolu Odetunde is head research at Korea Assets Management Limited. Thank you so much. It's really good to see you today. And enjoy your weekend. It's a Friday.
Yes, thank you.
All right then. Thanks.